All right, welcome back. You know, markets are very much the focal point, the focus area. And we've got yesterday's sharp sell-off to reckon with, right? I mean, this morning, of course, is absolutely flat. Rohit Srivastava is with us. He's founder of Indiacharts. And Rohit has been calling for lower levels for some time. His view has been that we are in a bit of a bearish phase here. Rohit, good morning. Good that you could join us today. So just lay out the view here. I mean, if you could just address what perhaps potentially could have happened yesterday, because it was a sharp sell-off and it doesn't show up in any numbers in terms of FI, DI, etc. And then, I mean, your view from here in the near term.
So I think it's a mix of things. Good morning, Prashant, and happy to be here. A lot of news flow around what might happen in Iran. I think that may have played to some extent on the minds of people. It's also that it was the weekly expiration. So if there were a lot of long bets, there could have been some unwinding. But people that I have met, a lot of our clients, especially HNIs, I think have been slightly concerned about the market, and it's possible that a lot of individual investors are trying to, book gains or create cash, and that could be also a source of selling. So pinpointing it may be difficult, but I think the negative news flow has really not gone away. Whether it's been around the AI trade, the tech trade, whether it's around Iran. And also generally that we don't see a lot of strength in US equities. Although we continue to see strength in Asia and emerging markets, they haven't shown any weakness yet. But US equities continue to show some kind of lackluster movement. And so I think all of that is playing into people, not being able to hold on to the long side of this trade. So that's where the unwinding is starting from. And it's also been pretty fractured because when we move from sector to sector, but before I come to that, let me address the market level. So what we are really looking for right now, yesterday the Nifty is closed below the 20-day average. So that's the first sign of near-term weakness. And we'd look at, if we stay below that, we go to test maybe 25,100, which is sort of filling the gap that we had made on the trade deal day. So that is the first thing that's going to happen. But after that, it's going to be looking at the monthly levels. When you consider this entire bull market from 2020 since COVID, even when we had corrections in 2021, 22 around either the Russia war or various other reasons, we did not fall below the 20-month moving average. And even last year, when we've seen corrections in the market, we've sort of not gone below that except for maybe a month and then rebounded from there. So that level comes in at 24718. Okay, so that's an important level to stay above on a monthly basis when we are considering Feb. So we have to maintain this bullish course on a broader basis and say that this is only a correction in a bull market. We would have to hold 24718. If that breaks, then the monthly bands come into focus, and those are way lower. That's almost around 22,750. So are we going to make that plunge of 1,000, 2,000 points? Will depend a lot on how we close for the month. So that's going to be an important read into how February really does, given that we have around a week, I think, left for the month end. So that's going to be the key level. Bank Nifty, of course, has been the outperformer within all of this, and has managed to push up to a new high. Yesterday we did see it sell off, and my momentum indicator did give a bearish cross, but it's still way above the 20-day average, which is at 60,086. So of course it's not showing the same setup as banking yet, but if it does close below 60,086, then we would open up to downside on Bank Nifty as well, down to maybe around 58,500. So that's the immediate setup as far as Nifty and Bank Nifty are concerned. And it does show that we have near-term weakness, and then the question becomes, how do we trade this on a sector basis?
So just to kind of a lot of numbers here on the Nifty, you're saying immediately is 25,100, right?
That's right.
And what's the what is the level on the upside which negates this view?
So, well, if we go above the recent high that we really made, 26,009, so I'd say around 26,020 is a resistance that we were watching. That would be a level to negate it.
Got it. So 25,100 on a monthly basis, 24,718 is the 20 monthly moving average, which did not break in prior corrections, but that comes into play, and then below that we'll see. I mean, if it comes to that. And Nifty Bank, you're saying is still above the 20-day, but if the 20-day goes, then you're looking at about 58,500, perhaps, right? It's been the stronger of the two indices, clearly, very, very clearly.
That's
Okay.
right.
So then from viewers who are watching, right, and trading, I mean, you want to be with the trend, right, and not try and do things when the kind of sort of, a broader, the bigger trend is, the bigger overlay is against you, then you get whipsawed and capital gets locked and stuck, etc. So what's the advice for viewers watching, Rohit?
Yeah, so there are a couple of things that have advised people over the last couple of days, and I can go from traders to investors. So let me start with investors first. And one of the strategies that have been publicly outlaying is that a lot of investors who buy for the long term, they're not comfortable that if you sell a lot of stock now and then how do I buy it back if the market goes up? And secondly, I may have to pay tax. And at the same time, there's a lot of news. What if there's a war? What if the India-US trade deal falls apart because of some Russian imbroglio? For all of that, the ideal way is that you buy a 1-year hedge, and it's still cheap because the India VIX has not gone up substantially. It costs approximately 2% to hedge yourself for the rest of 2026. So we are talking about December 2026 puts for the strike of 25,000. Till yesterday they were below 500. They may have crossed 500, yesterday. But even at that price, it still is around 2% of your portfolio if you buy that. So say, for example, if you have a 1 crore portfolio, 6 lot sort of covers 1 crore. One lot covers around 16 lakhs. So that is the coverage that you get for the entire year. So that's an easy way of really not exiting your portfolio, at the same time having a hedge against any unexpected, unprecedented news flow or knee-jerk reaction that the market might show you. So that's, I think, the simplest solution for investors that I could think of, where they don't really need to panic and get out of the markets, but you have a hedge for the rest of the year because too much news flow that we have to deal with every day. And then when you take this kind of a hedge, you should really not think about exiting it also every day, because immediately people ask me, "Oh, it market fell yesterday. Shall we get out of our puts?" Or when the trade deal news happens, should we book it out? And my answer is, you've bought it for the whole year. And when you're paying 2% for the whole year, you shouldn't worry about it, because say the market does rally 2,000 points from here and goes up 10%, maybe your portfolio gains 20%. Your option price might just drop by 1%. I mean, out of 2%, you lose half of it. And that's not a lot to lose against the gain that you would make having a hedge in place for an unprecedented news flow. So I think that is the simple answer. So do this for the rest of the year, and you would actually become, easy on yourself. You don't have to worry about everyday movement. So that's for long-term investors. Now, for traders, what we do is, we have seen that this market is pretty
Just come in.
fractured.
Sorry, Rohit.
Yeah.
Rohit, sorry. You're saying the 25,000 December 2026 put, 25,000 strike. That's what you said?
Yes.
Okay, got that. Go on. For traders, yes.
Yeah. So now for traders, the action would be to stay with the trend, as you mentioned, and which is still on the short side. And the market has been pretty fractured, which means that not all sectors are falling at the same time. You still had banking going up, and you still have stocks like Larsen making a new high. And at the same time, there is weakness in certain segments. So the simple thing I did a couple of weeks ago is I just looked at what is the 1-year performance of stocks and the 1-month performance of stocks, and which are the weakest sectors. So the top 3 weakest sectors in the market over the last year have been technology, that's the obvious one; real estate, which may or may not have been obvious to all; and thirdly, FMCG. Now, FMCG is mostly MNC stocks, low floating stocks, so we don't really give trading calls on FMCG stocks, but they've been weak, so we would probably avoid buying them. But the trades, therefore, on the short side, the easiest shorts are essentially in the real estate and technology space. Because those are the weakest segments, and anytime the market falls, you see a lot of selling happening there. So even yesterday, though tech didn't fall much, we saw real estate stocks fall 2 to 3% during the day. And probably today we are seeing some overnight moves that could affect tech. So that's the easy target till we can start seeing weakness spread to other parts of the market as well. So that's the approach we are taking. Look for even individual stocks. When we scan, we look for those which have been weak over 6 months or 12 months and are making lower lows. and look for opportunities to short over there rather than try to catch a top and try to say that PSU stocks, PSU banks, for example, are topping out, or PSU stocks are topping out, and try to short them. So that sometimes can be a little more difficult because it may not immediately happen, and there's a stronger segment. So target weakness in a weak market rather than target strength. We are still not seeing a broad-based sell-off in the market, which is why there is still hope that this is just going to be a temporary correction, and maybe it is a sector correction. So that's the hope the market has till it becomes more broad-based selling. And so accordingly, the trader application is that target the weak areas.
Yeah. Useful advice, directional advice, and a top-down view there, Rohit. So we'll leave it there, and we'll sort of continue to come back to you as we navigate these trades and this view as well. Thank you very much, Rohit, for joining us. Really appreciate it. And I think useful advice. I mean, just a frame of mind to think about when you are approaching things and doing things, both on the long and short side.